Welcome back to the channel, guys. I'm your host, Buck Ning, and today we are going to go through the portfolio really quickly here on our weekly update. And we're going to update the dividend tracker, but show you guys the performance thus far this year. We'll talk about a few things at the end once I give you guys the update here and update everything, just to give you that weekly update as we do every single Friday. But video shows up on Saturday. I don't know why I said Friday like that. But anyways, if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So today the portfolio closed out at $10,875.34. We are up $200.16. So kind of a nice rebound there in the portfolio. We're up 1.88%. For the 1 week, we are down $47.55, down 0.44%. For the 1 month, we're up $325.44, up 3.08%. For the 3 months, we're up $619.92, up 6.04%. For the 1 year, we're up $1,874.38, up 20.82%. And for the all, we're up $2,260.18, up 26.23% since starting this portfolio. The position we bought today was TD, Toronto Dominion Bank, but all ticker symbol is TD. Closing out this week at $104.68. It's up $2.34, up 2.29%. Currently have 8 shares of this. It holds 7.76% of the portfolio. I would like to try and get that position up to about a 10% of the portfolio. Today's return was $16.86, and our total return since owning the position is $163.37, up 24.24%. So if you don't know what Toronto Dominion Bank is, it is a bank in Canada. It's one of the big 5, as we call it. And yeah, it's in the finance sector. A very, very large company and on a great growth trajectory as well, with a great dividend as well. So today we did purchase 1 share at $104.20 this morning. The next position, as we always do when we make a regular purchase every single week, this year we will be adding $25 as well and putting that into the index fund VFV, which is the S&P 500, as you can see on the screen. This one closed out at $98.93. Today we are up $1.36, up 1.39%. Currently, we have 1.98 of a share of a couple shares. We have 1.82% of the portfolio that is in VFV. The average price of getting in right now is $100.76 for us. And our total return, we're down $3.64, down 1.82%. So if you don't know what the S&P 500 is, it's the top 500 companies in the US. And all it does is it tracks the performance of all those companies. And essentially what you're buying is this thing called a trend line, the average trajectory of all the companies and where it's heading. And so that's how you get consistent growth over time. So as you can see, over the 5 years, it's been up 79.48%. In this fund in particular, Vanguard is a very large company and a very well-known company. And so it's great to have them. And this is a non-hedged position. Okay, so it does work around foreign exchange as well, so the Canadian dollar to the US dollar. So if something happens there it will reflect on the stock price as well. So the next thing we have here is our cash position, which is at $84.58. I didn't make any other purchases. I'm not going to throw that in VFV. I'm just going to save it for the next purchase. So with that being said, we'll head over to trackyourdividends.com. Today, dividend yield is 3.36%. This is the current portfolio value from last week there. And yield on cost for us is 4.29%. Annual income sits at $358, which is fantastic. And we'll go ahead and update these positions. So if we go to TD, down at the bottom there, we have 7 shares and so on and so forth. Currently, it gets us an annual dividend of $24.92. So we'll go ahead and add holding. And the ticker symbol for Toronto Dominion Bank is TD.TO. The number of shares we bought was 1, and we purchased it at 104.20. Add that holding and done. And then we'll also add VFV. Go ahead and add that holding. And yeah, so that's where we're at. So as you can see here, Toronto Dominion Bank dividend has changed to $28.48 for the year. And the dividend for VFV, which it does pay out, is $2.24. As you can see here, that is the portfolio value. Dividend yield today, if you were to build the exact portfolio, is 3.36%. Yield on cost is 4.27%. Annual income has jumped up a whopping $10 to $362. And then we'll head over to ShareSite, which is already updated here. Everything is updated. We have 8 shares of TD, 1.98 of shares for VFV. Currently, at the calendar year, in this calendar year, as you can see at the top, we are capital gains of 1.55%. That's up $164.46. We've received dividends of $45.97 in the portfolio, which always get reinvested to purchase the next stock, and that's up 0.43%, and a currency gain of $12.19 since the beginning of this year, up 0.12%. And our total return this year, including everything, currency gain, dividends, and capital gains, we're up 2.1%. So that is the portfolio thus far this year, taking in factor that with everything happening and really just so much information. And so that is ShareSite. So 2.1%. The one thing I do want to talk about, though, is this right here. So this is Bank of Canada. So total CPI inflation. If you don't know what CPI is Consumer Price Index. This measures the cost of staples, goods, and so on and so forth. Usually it's about 2% roughly in Canada. Inflation is 5.1%. So you can see that really in gas prices, in the cost of goods. But I think people really take notice when they find out that their $100 that may buy groceries does not go as far or purchase as much goods than it did the year before or the year before that, and so on and so forth. It seems like the amount of groceries you gets smaller and smaller, even though the $100 did not change. And that's because of inflation. So small incremental raise in prices due to cost of goods. So the cost of living is another way of putting it. Your cost of living is going up, and a lot of people notice it in gas prices because you can see the actual numbers. They post it every single day on those gas stations, so you see it and it's like mentally ingrained in your head. And why am I talking about a 5.1 inflation rate in Canada is because if you're building a portfolio, and we're going to get back to this, if you're building a portfolio, you want your portfolio to typically have a capital appreciation higher than what the inflation rate is. You want to beat inflation. If you can't beat inflation, you will run into the situation where you feel like you have a lot of money, but you also feel like you don't have enough money because the cost of goods is so much. So you may have $1,000, and that $1,000 doesn't go as far as it used to. When I say as far, it does not buy you the same amount of goods that it did in the previous years. And so for me, that's pretty much one of the main focuses, just to make sure the capital that is invested is always appreciating in value, but keeping up or even surpassing inflation. And that way, your money is actually growing. So if your portfolio is down, maybe 5-10%, and inflation rate is 5.1%, you got about 15% of catch up to do just to be on par with inflation, to have essentially the same amount of money that you did this year to the previous year. You want to be on par with that. So it's a new year. A lot of people work the 9-to-5 job or a job, and they've probably noticed that they get raises at the end of the year. If you calculate the percentage of what you got for a raise to your total income, and then compare that to inflation, I probably would imagine that your raise at work isn't higher than the rate of inflation. And so that means you are still falling behind when it comes to cost of living. So it may feel like you're making more money, but it also at the same time feel like you're not making enough money. And that's due to the cost of living. That's really what I wanted to just talk about briefly on that. And this is the policy interest rate that could potentially happen in the increase in prime through Bank of Canada at 0.25% or 25 basis points. And that affects people borrowing money. It just costs more to borrow money, which means for businesses that require capital or require to borrow money will cost them a lot more, which essentially could affect how fast they grow their company or expand their company. Because when it's cheap to borrow money, when the interest rate is low, they tend to borrow a lot of capital to expand very quickly to turn a profit. There is a lot of stuff happening in this world currently on the other side of the world, and it's affecting pretty much all of us. And I'm not going to go into detail about it, but there has been so much information in the past couple weeks. It has been a wild 2022 already, and I don't know what to make of all of it. I'm not going to pretend that I know. I'm not going to pretend that I know why the market is the way it is based on these events. I'm not an economist. I'm not a financial advisor. I'm just not any of those. And so when it comes to all this stuff, to be honest, I'm at a loss right now, and I'm still processing everything that is happening. And yeah, it's got me in a funky place. And so other than that, guys, I'm going to figure it out. Then we're going to come back on Wednesday for the next video. And I'm probably going to figure some stuff out, and we'll probably talk about that. But if you guys did enjoy the video, don't forget to leave a like, subscribe, and have a great weekend. And we'll see you in the next one. Bye.